Good morning, everybody. We will get started. Thank you so much for joining for our Fiduciary Training 301, Strategic Fiduciary Oversight for 401(k) plans. My name is Jenna Witherbee, and I am one of the advisors on the team at 401(k) Plan Professionals. And if you are not familiar with our team, we are an advisory firm that focuses 100% of our time on retirement plans. And part of our role is to work with plan sponsors, and the other part is to work directly with participants. And today's webinar is a part of our fiduciary training series. In the past, we have done a quarterly training and we would cover everything at one time. And this year, we decided to break it up into three of them: 101, 201, and 301. And so today's webinar will be 25 minutes. We'll leave some time for questions. And the next one of these is in February 2026. A recording of this will go out to you. Feel free to rewatch, share it with anybody you think may find value in it. And this will live out on our website, 401kplanprofessionals.com, and our YouTube channel, along with all of our previous webinars and educational videos as well. You will get a fiduciary guide and a checklist, and I will talk about an optional credential that you can get as well. So here's kind of a roadmap for our fiduciary training in 2025. First, we covered 101, more your role, basic duties, administrative best practices. 201 was more hot topics in our industry. Our industry is constantly changing, new legislation, new rules. And so we talked about what was really top of mind for plan sponsors right now. And then today we will go through more strategic fiduciary oversight. So kind of that higher level of fiduciary responsibility. And then you can use this QR to bring you to the recordings of these and all of our other previous webinars. So today I'm going to briefly recap 101 and 201, and then we'll hop into more advanced concepts. So talking about investment due diligence, plan design, different types of insurance and protection, cybersecurity, audit readiness, things like that. So from 101, we talked about your role as a fiduciary. And you may be new to your role as a fiduciary. Maybe this is a role that you've been in for many, many years. I think it's always good to just kind of go back to the fundamentals and the basics. So this is an individual or an entity who exercises discretionary authority over the management of a plan or the management of its assets, provides investment advice for a fee. So this would be like myself, the advisors on my team, or has any discretionary authority or responsibility in the administration of such a plan. And the basic duties can be put into these five kind of main categories. So, number one, managing the plan with the interest of participants and their beneficiaries in mind. So, you are not self-serving, even if you yourself are maybe a participant in the plan that you're managing, you are coming at your fiduciary responsibilities with the lens of I'm doing what is in the best interest of all participants. Keeping plan expenses to a reasonable level, following the governing documents. We'll talk about that more in a moment from a plan design perspective, making sure you are following in practice what your plan documents say, ensuring the investments are diversified, and then doing all of this with care, skill, prudence, and diligence. Here's some sample materials that you may find in a committee meeting with our team: an agenda, minutes. We do all of the minutes and we send them out in advance. We also keep a record of them in our office. We'll talk more about managing documentation as well in a moment, but we keep a copy, you should keep a copy. The plan review that perhaps your provider has more analytics and data on your plan, investment policy statement, the actual investment analysis itself, fee analysis, and then we like to talk about our plan for executing education for your plan. So in 201, again, we talked about the legislative update, mainly Secure 2.0. This was a large piece of legislation that was passed a few years ago. And over the past few years, we've been implementing pieces of this legislation for 401k, for retirement plans. Some provisions were mandatory, some were optional. So really just talking through those things and from a due diligence standpoint and a documentation standpoint, what plan sponsors are needing to do. Talking about what's coming kind of around the corner with Secure 3.0, the next set of legislation. Talked about lawsuits, different litigation that we've been seeing just industry wide. And then state mandates. You may not be located in a state that does mandate a retirement program. Minnesota is starting their state mandated program 1/1/26. So all employers with 5 or more employees must offer their own retirement plan, or they can be a part of the state plan. So we spent a little bit of time talking about that and an option with a pooled employer plan. We also talked in 201 about custom education. This is a part of our fiduciary responsibility that my team has a lot of passion for, and we spend a lot of time doing. We are able to customize our communication with you and your staff. So, doing different things like in person group meetings, in virtual group meetings, one on one sessions, whether those are in person where we come on site, or maybe we have the sign up where they can select a 30-minute Zoom session with us. We do a lot with different flyers and QR codes and really just trying to get people to take action and make it easy for them. We've had appearances on, say, all staff meetings, or if we can be a part of your open enrollment meetings, that's a really great captive audience. Doing different things with email and video and embedding short videos into email communications from you. So we're always open basically to doing different things and seeing what works best for you internally. Okay, so I do have a poll for you. Um, what do you think you are doing really well right now as a plan fiduciary? So it could be multiple things. Select all that apply. Um, I'll share the results here in a moment when we get them. So, what do you think you are doing really well right now? Self-assessment. Okay. Thank you so much for everybody who answered. I'm going to end the poll here and share the results. So, pretty spread across the board. Um, Great job. I mean, generally about 50, 60, 65% are all kind of doing investment due diligence, fee benchmarking, education engagement. So some room for improvement. But overall, I'm really happy with that. Great job. And the fact that you are on this webinar as well says that you care a lot about your fiduciary responsibility. Okay, so now investment due diligence at the next level. Something that we do as advisors is we come prepared at committee meetings with the investment due diligence and maybe even more alternatives, additional analysis on funds that we want to take a deeper dive on. Maybe they're of concern, maybe they're on the watch list. And so we try to be proactive with the discussions we're going to have. We do send those out in advance as well if you have some time to review those prior to coming into the meeting. Another great piece of documentation to kind of overlay those investment reports is having an investment policy statement on file. And this is not something that needs to be changed or even reviewed at every single committee meeting by any means, but this is something we have on file that is basically outlining the process that we are taking during our committee meetings, to cover the investment analysis. So, what may be reasons to add a fund, remove a fund, what would cause concern for us? So, looking at different qualitative and quantitative factors. And the investment policy statement is more broad. You don't want it to be too specific where it's hard to follow. So, for example, we don't want investment policy statements that say, our funds will always outperform their peers over the last 12 months. That's too hard to follow. And there are times where maybe your fund does fall a little bit out of favor in a 12-month period of time. That doesn't necessarily mean we're going to remove it right away. So it's more of broad language. We've had ERISA attorneys review our investment policy statement language and making sure that we're covering our bases. You would sign this as a plan sponsor and you'd keep it on file. We keep it on file as well. And this is something that we're reviewing every couple of years. Revenue sharing versus fee levelization. So some plans have what we call revenue sharing, and that is where the different mutual funds in their plan lineup, within their investment expense, they have some revenue sharing built in that gets kicked back to the provider for servicing the plan, for being your record keeper, and perhaps also to us as advisors for doing our work on the plan. There is nothing wrong with fee levelization. So, this is all disclosed in the fee disclosure, annually goes out. Sometimes, though, it's not as transparent because not necessarily everyone's reading through every page of the fee disclosure, and it can kind of get confusing. Okay, here's the expense ratio, and then it's basically divvied up into multiple pieces. Some is going to the investment manager, some to the provider, some to the advisor. Also, plan size comes into play here too. So we have found in our experience that sometimes a plan gets to the size where they can kind of graduate to more of a fee levelization approach, which is where you'd use zero revenue sharing fund classes, so the least expensive share class of that particular fund. There's nothing built in to kick back to the provider or the advisor. So then you'd have an asset charge on top of your investment expense. And that asset charge is flat, it's level. So everyone would pay the same thing. So I'll give you some examples here. So let's say you had a plan and you have XYZ large cap value R share. The expense is 1.15%. 50 basis points of revenue sharing gets sent to, say, the provider and the advisor. So 65 basis points goes to XYZ as the investment manager. An A share, very similar, has a 90 basis point expense and only 25 basis points of revenue sharing built in. The investment manager still gets their 65. Now, a plan may get to the point where maybe there's too much revenue sharing that's generated from the funds, or they say, we just simply want to move to the fee levelization, have it more clean. We want the least expensive share class of XYZ large cap value. And then, sure, on top of that, we'll tack on the asset charge. So they could go to the XYZ R6 share class, which has a 55 basis points expense that goes to XYZ as the investment manager. And then let's just say there's an asset charge of 25 basis points that gets added on top. The nice thing too about fee levelization, in addition to transparency, is that all participants in the plan pay equally. Whereas in a revenue sharing environment, some funds don't have any revenue sharing built in or maybe very little, where some have a lot. And so if a participant is maybe invested in all index funds and that's their choice, they don't have much revenue sharing built in. So in essence, they're not really paying much, if at all, for the plan, whereas the participants in the higher revenue sharing plans are the ones kind of footing the bill. And again, nothing is inherently wrong with that, but fee levelization is something we've seen more and more of. In larger plan spaces, you may even look at the CIT version. So you can see on the screen, we may be able to get access to a collective investment trust version of that particular mutual fund with an even lower expense. So these are things that, we're kind of getting into the weeds here. These are things that we're constantly looking at. I've had plans too that I've looked at fee levelization maybe 2 or 3 times, and it just didn't make sense from a pricing standpoint yet. But once the plan got a little bit bigger and we went to the pricing department and it made sense financially, then we were ready to kind of make that leap to fee levelization. And we take care of, educating your staff, making sure they know the difference and what they can see on their accounts and just kind of the differences there. Also, I would say this is more advanced, kind of looking at unique asset classes or unique structures. We've seen a little bit of an uptick in ESG funds in a plan. So, funds that focus on environmental, social, and governance factors. Maybe we have an organization that says we don't want to invest in anything, or we want to have an option for our staff that doesn't invest in alcohol type of stocks or tobacco or guns, or we want to make sure that the leadership and the boards have a lot of diversity. And so looking at some of those kind of factors when it comes to screening the investments. Different types of managed accounts we're seeing a little more of, and those are either advisor chosen or even some 401k record keepers and providers kind of have their own products or their own types of managed accounts, sector funds, and then pooled employer plans is really more of a structure for your plan. But in a PEP, we're able to get less expensive share classes in a lot of cases that maybe you were able to get on your own in a single employer plan. I mentioned following your plan documents. So your plan documents like your adoption agreement and your summary plan description, they describe your plan design for your plan. And those are really important not only to follow, but also from a consultative standpoint, we like to help plans make sure that they are using their retirement plan as a strategic tool for broader business goals. So maybe you um, have a really healthy match or a profit sharing component, and you want to really highlight that, or your eligibility is, right away, they're eligible to enter the plan. Um, so different tools like that can be used with recruiting and retention. So just making sure things like eligibility, the employer contributions, distribution options, and the automatic features are used in a way that you can really highlight your business goals. So auto enrollment and auto escalation are a couple of really popular provisions. I'll talk about those more in a moment. So, Fidelity does this plan sponsor attitude survey every year, and this is data from their 2024 survey. So, attracting and retaining top employees in order to remain competitive in their workplace is one of the primary goals for companies offering a plan. And one of their top concerns is whether the plan is helping attract and retain top talent. Over the last couple of years, that's definitely a theme we've heard from business owners and human resources professionals is trying to find people to fill roles and find the right people as well and keep people in your organization. As far as plan design changes made in the past 12 months, 28% said they added automatic increase to their deferral rate, and that was the top change from the year prior. And then as far as what changes they were expecting to make in 2024, 32% said to add automatic increase to their deferral rate. That was their top change again. So a lot of plans have really embraced the automatic enrollment type of a feature. And now we're really seeing the surgence of adding that auto increase piece kind of on top of that. And we could have a whole webinar on just this topic. So we're going to have a plan design strategy webinar in May, and we will really take a deep dive on ways to creatively make your plan design, and also talk about those regulatory requirements and different legislation that we've been seeing. Analysis on different employer contributions. We do this all the time. So looking at different match formulas. Maybe you're not passing your discrimination test, so want to look into becoming safe harbor. Maybe you just want to know, how do we stack up against our competitors, against peers in our industry? We have industry reports as well. We can really drill down on the data and look at, how is your eligibility compared to your competitors? How is your employer contribution, your vesting, all those different pieces. We have also been seeing some plans adding more creative things like adding an after-tax option to their plan design and even a self-directed brokerage option to their plan design. All right, so then insurance and protection layers. These may not be new concepts to you, but I just wanted to review them because they are very important. ERISA fidelity bonds, if you have filled out a questionnaire when you do your annual compliance testing, this is of course on the questionnaire every single time, but a fidelity bond is a type of business insurance that offers an employer protection against, say, fraudulent or dishonest action caused by their employees. And you need to hold fidelity bond insurance equal to or approximately 10% of plan assets at the beginning of the calendar year, up to 500,000. And a lot of plans will utilize their general business insurer and then just have this fidelity bond insurance basically as an ancillary piece. There's another kind of ERISA insurance called fiduciary insurance, and this is more on an individual level. This isn't required, it is advised, and this would protect you as an individual against if someone were ever to come to you and say, I'm going to sue you because of how you administered the plan, then your personal, assets cannot be on the hook for that. Documentation and your fiduciary file. We keep copies of everything as well, but it is important for you as a fiduciary, as a plan sponsor, to make sure that you have your own internal fiduciary file, whatever this means to you. This a lot of times we see electronic files, some do both electronic and physical files, but this is things like plan documents, the legal adoption agreement, summary plan description, any amendments that you've had to make changes over the years, investment selection and monitoring documentation. So this would be what we prepare basically for the committee meetings with you. You want to save all of those, at least one person, not every single person needs to, but have a central file. Fee disclosures that you get from your provider, the Form 5500 tax filings, vendor due diligence. So anytime you benchmark your fees, which best practice is at least every 2 to 3 years. Even if you're happy with your provider, you want to make sure you're benchmarking their fees. Make sure you're keeping that on file as well as any cybersecurity reviews. So knowing what your provider's cybersecurity policies are and keeping record of that. We talked about the minutes, those are really important, and communications with your service providers. Some record keepers may have an internal kind of fiduciary vault that you can utilize, and they maintain a lot of operational records too, obviously, but that doesn't mean that alleviates you of that responsibility. So you'll still want to have your own file as well. If you are to get audited, we will absolutely support you every step of the way. There's a few different type of audits I want you to know about. So one is the Department of Labor. They can audit your 401k to ensure compliance with ERISA and protect participant rights. So here they're focusing on, are you following your plan documents? Are you sending out your annual required notices? They're looking at plan operations, disclosures, things like that. The IRS may audit your plan to more so ensure compliance with the tax code. Um, Both are rare, but can happen. And so here, just kind of going back to that documentation section, just making sure you have everything ready and available to provide if needed. There's also an independent audit that's required of some plans. So there's a large plan audit required for plans with 100 or more eligible participants. The first year you have to cross that 120 threshold. That would really get the clock ticking on the audits. But let us know if you have any questions on that. This is conducted by an independent qualified public accountant. We work with many of them, so we're happy to align you with resources there. But they review financial statements, make sure the contributions are going in timely, make sure the distributions are processed properly, you're in compliance with ERISA, and um, tell you if you do need to make any corrections, giving you instructions on how to do that. Timely and accurate deposits are a really key component of any sort of audit. So, really making sure that your contributions are going in on time, that is huge. Ensuring participants are getting any sort of statements and notices, disclosures that they have to. Nowadays, a lot of providers can take care of that piece for you, sometimes for a fee. But that may be something to kind of take off your plate from an administrator standpoint. Timely and accurate filing of the 5500s, reviewing that fees and expenses are paid on time. I wanted to mention here again the pooled employer plan. If the administration of your plan is very cumbersome for you, if you do have to do an audit and that is a big thorn in your side, um, looking into a pooled employer plan environment may be worthwhile for you. When you are in a pooled employer plan environment, there's only one tax filing for the whole plan. There's only one audit for the whole plan, which may be composed of many different individual plans kind of underneath it. And so here you're really able to outsource a lot of those administrative type duties, and we can absolutely help you with looking into that. We've also had a PEP webinar recently that does a deeper dive there. The main thing is having that documentation showing your prudent process in place. That is, even if your fund decision that you made wasn't the best one in hindsight, looking back 5 years prior, as long as you made the best decision with the information that you had at that time and you documented that process, that is the main thing. Lastly, cybersecurity. Different providers will have cybersecurity policies in place. This is safeguarding and protecting you and your participants' information. Not only knowing what your provider's policies and security guarantees are is important, but also knowing if there's any kind of fine print or caveats with that. This is just an example, but Empower has a retirement security guarantee, so they will make a participant whole if there's any fraudulent activity on their account. They, of course, encourage people to sign up for the multi-factor authentication, register your account, make sure your contact information is correct. But even if one doesn't register and make an account, this security guarantee still applies. There are some providers that say we will only um, make your account whole if you've done your homework with making sure you've registered account and signed up for dual authentication. So there are differences from provider to provider. So knowing where yours stands is really important. Okay, so we have a checklist for you as you're going through strategic fiduciary oversight. I'm going to be sending this to all the attendees today. So just kind of going through, do we have an investment policy statement on file? Are we benchmarking our fees? Do we have a vault that has all of our documentation on file? So just kind of do an assessment and see if there's any places you can improve. There is a survey when you exit out of here. And one of the questions is if you want a code to go through this additional fiduciary training. It's called Fiduciary Essentials for Defined Contribution Plans. It's basically helping you solidify your fiduciary responsibilities and your decision making process. There is 3 sessions, 3 quizzes, and there's a course assessment at the end. And then you'll get some additional resources throughout the process as well. If you have any questions, you can drop them in the chat. But additional resources here, our website, 401kplanprofessionals.com, and then our YouTube channel. And that has the recordings of our previous fiduciary trainings as well as our other webinars. And coming up, we have several webinars that are focused on plan participant education as well as some plan sponsor education. And so you can use this QR to register for any of these. We encourage you to share them too with your staff. And our next one coming up is November 13th. I'll actually be doing a deeper dive on our 8 steps to financial wellness. This is very well received for plan participants, kind of going into other areas of their financial life, not just their 401k account. And we created a worksheet that goes along with the 8 steps. That is another really great value add for your staff. All right, I'm going to see if there's any questions that have come through. I don't see any. If you think of anything, please give me a call. Here's my phone number and my email address. Myself and the other advisors on my team are more than happy to help you out. If you would like to even just set up a quick call with one of us and we can go through that checklist with you and talk through your processes and make sure that you're doing everything you need to do as far as your fiduciary responsibilities. All right, thanks everybody so much. I hope you have a great rest of your day. Take care.